So you got some stimulus cash dropped into your account and you want to multiply it? Here are 10 stocks cheap enough to buy with your stimulus money. What's up, my milk money millionaires? I'm Joshua. Welcome to my channel where we learn how to make our money, make more money. And on this channel, I'm trying to teach a variety of strategies for building wealth, everywhere from safe dividend portfolios to selling options to having some speculative stocks to juice up your returns. If you'd like to see more of this content, please like and subscribe. I appreciate the support so I don't have to quit and start a cute cat video channel. Also, if you want a free stock on Robinhood or $30 off a TradingView account to read stock charts, check out the links in the description below. Thanks so much. For this video, I have chosen 10 different stocks that are cheap enough to afford 50 to 100 shares with the stimulus payment, or more if you got a fat family check. Not that your family's fat, but the check is, hopefully. All right, I chose stocks with different risk levels and strategies, so there should be something for everyone. We'll start with some safe, reliable stocks, then move to some trending stocks for higher returns, and end with the fun, juicy rocket ship stuff for the more risky folks. And then maybe you can buy a combination or pick which one fits your risk tolerance. So first, a reminder, I'm not a financial advisor, just a YouTuber, so do your own research and make your own trading plan before investing at your own risk. All right, so let's start with the safe, boring pick first, for those of you who just want an almost guaranteed set it and forget it return. And for that, we have the most reliable stock ever in AT&T. It's very hard to lose money long-term with T, and it's a beloved stock because of its safety combined with a 7% dividend. That means if you got a family check, you could buy, say, 200 shares at $30 and it never goes up a dime, or let's say it never goes up a dime, you would still have 20 grand by the time your new baby goes to college. Good start to a college fund, although by then it might only be enough for the books. The other good news is that Morningstar estimates that AT&T is undervalued by $6. And if the rotation of value and safety continues, then AT&T could reasonably get to that price, leading to a 20% return on share price in addition to that juicy dividend. T is boring, yes, but sometimes boring can be a heck of an investment. Now let's dial up that risk just a tiny bit for a still pretty safe, boring play with a little bit more momentum, and that is a Buffett favorite, Kroger. You could buy beer there, so I guess it's a little more fun than AT&T, but still a pretty safe, reliable, boring stock with a less rich but more typical quality dividend of 2%. It's also in an uptrend and slightly undervalued, so you might get a little more price appreciation than with AT&T. It's trading at $33 and T is at $30, so I know you might be like, hey, I thought they were going to be super low price picks. Don't worry, most of the rest of the stocks in this video will be less than $30. But usually a quality, safe dividend company is hard to find for much less. All right, so let's get it up to a medium, low level here and get a little bit more interesting stuff. All right, so we're going to start with Rocket and UWMC. So Rocket has been getting a lot of attention on Reddit and was a killer buy at $20 when I made my videos recommending it. But now that it's been on a run, you might feel like you're chasing. So if you want a safer bet, you could bet on UWMC, United Wholesale Mortgage, which has been beaten up since debut, down from $13.50 down to $8.43. It's been holding steady there, and the Rocket push could spill over into the second largest mortgage company next. It should be relatively stable and has a high dividend at $4.73. The key here is, what do you think the mortgage and housing markets are going to look like going forward? If you're bullish, then you can be bullish on these stocks. All right, let's move to medium risks now. For this, I like good companies that are more cyclical and benefiting from a market or sector trend. They might be more risky because they have been trending already, so it's a step up in risk from the previous picks, but it's also got a little more fun and a little more upside as the trend continues. They are quality companies though, so the risk isn't too extreme. For the next two picks, we'll be benefiting from the strong rotation into the rebound of the energy sector, which was absolutely destroyed during COVID, and this sector has rebounded quite nicely as of late. You definitely don't want to feel like you're chasing, but if it started a nice dip, which it looks like it has here in the last few days, it can get a lot safer. And if you think the economy will be getting much stronger and the energy rebound will continue, then these next two picks are going to be great buys for a medium-term recovery trade. The first is Antero Midstream, which is a cheaper stock. You can buy almost 200 shares with your stimulus check at $8.74. The good news is that's a price after a dip from its recent high of $9.60. So if we got back to that recent high price, you'd be already up over 10%. Plus, it's got a huge dividend. They operate known energy infrastructure, so if the energy market is hot, they should be too. You might be worried that you haven't heard of this stock, but buying stocks before everyone else has heard of them is a good thing. An alternative is SXE or Suncoke Energy, which is a Michael Burry pick, so it might have more attention. But either way, getting something in the energy play could be a good bet. The energy trade can also be played by just buying oil through US Oil, which ticker is USO. It has been red hot. It's a little risky since oil has already been trending, but looking at the chart, the trend looks very strong. And if you believe in the inflation trade or the recovery trade, then buying some oil can be a great way to play it. An alternative and slightly less risky bet would be to maybe play a basket of commodities instead of just oil. You could buy DBC, a commodities ETF. If we do get strong inflation, then commodities could be a great place to be. All right, now to another sector that's been red hot, and that is cyclicals. Companies like Ford bounce around forever as the economy struggles and then does well. Ford has been very strong as of late and can continue to do well if we keep getting strong economic news. You could get lucky and some of the EV bubble hype could spill into Ford if their electric Mustang does well or the electric F-150 gets some buzz. It's definitely a little risky and that has run a lot already, and Ford doesn't really like to get too high for too long as a cyclical. But with a recent dip from $13.50 as its high and still being in a strong uptrend, you might be able to make a quick 20% this year if it rallies to its Morningstar estimate of fair value at $15. However, this wouldn't be a buy and hold for me, just a trade, and I definitely take profits. Who knows? It could be we could get lucky and it could be a hot stock for the year on EV hype, but typically a cyclical like Ford likes to go down after it does well for a while. All right, so we've got the safe and medium stuff out of the way. Let's up that risk level and see if we can get some more juicy returns. First off, for the safest of all my risky stocks, I got Aphria from the highly speculative Mary Jane sector. This sector has been red hot this year with the hopes of Dems making MJ legal. It's also been very volatile though, so tread carefully. But currently it's on a dip, so that's when you want to buy risky stocks, as long as you think that trend will return. Also, I like Aphria versus other MJ stocks because they own Sweetwater Brewery, one of my favorite beers, and that means they have some diversity to their income. I could see it pulling back to under 18, and maybe we'll get lucky and it'll hit its low of 16 before resuming its uptrend. An even higher risk ticker in this sector would be something like SNDL, which is a grower. It has a lot more upside, but the odds of it succeeding are also much lower. Another highly speculative stock that was red hot before the tech wreck is Nano Dimension, NNDM. It's risky not because it's a bad company, but because it's early and very speculative. They develop 3D printing of circuit boards, which sounds incredibly promising, but they are very early and only have a handful of customers. If this technology in this company sticks around and their business proves itself, it could explode. If they can execute or sell, or if the tech doesn't quite pan out the way we think it could, then it could crash. So it's more of a gamble, and you want to research the company to see if you really think this technology can win. But if it does, you could do very, very well. It's also down 70% from its high. So if it continues to dip under 10, maybe to its recent low of 8, you might be getting in at a much safer buy price. If the tech correction ends and people get back into this sector, then NNDM should rebound very well in the short term. Now for some super high risk, we got a Reddit stock in AMC. I picked AMC over GME because it hasn't quite pumped as much and it's still cheap enough to buy 100 shares with your stimulus check being at a $13.40 stock. AMC was struggling before the pandemic with the stock trending down for years and then tanking during the pandemic. They were on their deathbed before Reddit saved the day, allowing them to trade their debt out for shares, and after issuing new shares, they should have enough cash to survive. It's pretty high risk as it's been pumped, and that means it can dump, but it can also pump to the moon if Reddit has their way. And lastly, for one more high-risk stock is BNGO, another very speculative play in the even more speculative biotech sector. BNGO was a penny stock that pumped to $16 very rapidly in 2021 and then crashed when ARKG crashed down to almost $6 and has recovered a little bit now at $8.79. If you think that this correction is ending and money will move back into the speculative ARK stocks, then you could double your money in bingo. If their gene mapping technology isn't adopted or the sector corrects again, then you can lose your shirt as well with BNGO, as it could go back to under $1. So again, be very careful. For me, I think I'm going to put a little bit in each of these risk categories this month. Which ones are you picking and why? Are you going with the safe buy and hold or all out on the risk? Let me know what you're picking and why in the comments below. Also, please subscribe if you want more videos like this, including 5 cryptocurrencies to buy with your stimulus check coming soon. Again, I'm Joshua. Thanks so much for watching, and I can't wait to see you in the next video where we're hopefully all a little bit wealthier.